Very good morning, friends. First of all, wish you a very happy new year. So I'm meeting you for the first time in the new year. Hope this new year brings you a lot of, I would say, fulfills your ambitions and also brings a prefix CA in front of your name as well. So last class, we had started off with the concept of business combination. I had given you the introduction in terms of when does this standard gets triggered. And just to remind you, the three steps which I gave you when the standard is going to trigger. One is we look at first focus is that you need to acquire more than one asset. It is to be a group of assets with or without liability. That is focus one. The second we saw is that this should be a business, and we also saw the test which decides when it is supposed to be a business. We have the concentration test and what we call the three-element test, that is input, process, and output, which will decide whether the group of asset is a business or not. And then the third step is identifying that you've got a control over the business. It is only when you fulfill these three parameters, group of assets, which is a business, and on which the acquirer gets a control, then Index 103 is going to apply on the date of acquisition. Now, we are going to take it forward. I also give you the inputs that once Index 103 would trigger, three kinds of accountings can trigger depending upon the facts of the case. I give you one is called acquisition accounting. The other one is called a reverse acquisition accounting. And the third is called a common control transactions. I also give you a little clarity in terms of things generally. I think I'll just like to put this down as well. I'm saying generally. The thought process which should come to your mind is generally when you're looking at a transaction between a unrelated party. When you're looking at transactions between unrelated parties, that means the acquirer and the acquiree are supposed to be unrelated parties. Then in this particular case, it could turn out to be either a case of acquisition accounting, or it could turn out to be a case of what we call a reverse acquisition accounting. It could be a reverse acquisition accounting. So generally, when the transaction is happening between, you can say, unrelated parties, either of these two accountings would trigger. And if it is supposed to be a transaction between related parties, that means acquirer and acquiree are supposed to be related parties. Generally, I'm saying generally, the possibility is quite great that this turns out to be a common control transaction. This turns out to be a common control transaction. But yes, as I said, generally this happens, but there is a possibility that it is a related party transaction, but still it does not meet the parameters of a common control. I'm not yet giving you the parameters which will decide whether it is a common control transaction, but if it doesn't turn out to be a common control transaction, then in this particular case, if it doesn't happen to be common control, then it could be a case of acquisition accounting or a reverse acquisition. So the basic thought process to be looked at is that if there is no related party transaction, undoubtedly it cannot be a common control. That would be a case of acquisition, or you can say a reverse acquisition. And I also give you a very basic litmus test. And I said that when as an acquirer, you lose a control post acquisition. So A acquires the business of B, but after making a consideration payment to the shareholders of B, A loses the control over his own company. In this particular case, it happens to be a reverse acquisition. So it would be acquisition or reverse acquisition if it is unrelated and it's going to be a common control generally. And if not, then it could again be acquisition or common accounting. So I would say these are, you can say, the three types of accountings which are defined in terms of the standard. Now, if you look at where the guidance is given in terms of these three accountings, you can see the acquisition accounting is given as a part of the main standard, which I said earlier as well. The reverse acquisition accounting is given in terms of the Appendix B of the Ind AS. And if you look at the common control transactions, it is given, the guidance is given in terms of Appendix C of the Ind AS. Now, what I'm going to do, first of all, we are going to make a walkthrough in terms of each of these categories. I'm going to start my inputs in terms of acquisition accounting. Then we'll go to the reverse acquisition accounting and then a common control transaction. So we're going to proceed in a very sequential manner. So my focus of discussion now is going to be completely on acquisition accounting. Okay, in the meantime, let me also request, for those students who have just joined in, you would have seen a message in the chat as well. And only for the purposes of record, if you could just share your registration number on the chat box, that would be great. Okay, so let me now start the input in terms of the acquisition accounting. Now, as far as acquisition accounting is concerned, to make it easy and systematic, what I've done, I've divided the entire acquisition accounting into a 7-step model. In fact, a few steps are also mentioned in the standard as well, but I've converted the entire inputs into a sequential process. So when we're going to attack a particular question, we are going to attack a comprehensive questions in 7 steps. Now, you could even get a questions, in isolation on just a particular step as well. So there are 2 kinds of questions you could confront in the standard. Either you get a question which is a complete package where all these 7 steps are going to be applied. Or you would see that there is going to be a question which pertains to a particular step. Well, not all these steps, you could get individual questions, but there are certain steps which are quite comprehensive indeed. And you could get a question, independent question devoted to a particular step itself. So let me first lay down what are the 7 steps to be applied. I'll just, map up your mind in terms of things and proceed. So at the first instance, let me tell you one thing before I give you these 7 steps. Let's say, for example, there is a company A and there is a company B. Now, in this particular case, the company A acquires the business of company B. So mind the words carefully, because I'm now going to give you a thought process of the 7 steps which you need to keep in mind. So let's say, for example, A acquired the business of B. So let's assume that A got a control over the business of B. So once you're able to prove that A gets a control of the business of B, Ind AS 103 would trigger. And if Ind AS 103 would trigger, let's assume for the time being that A is supposed to be the acquirer. So A is going to be technically called the acquirer, and B is going to be technically called the acquiree. So A is going to be called as the acquirer and B is going to be called as the acquiree. Now, in this particular case, what A is required to do in his books on the date of acquisition, mind each and every word carefully. What A Limited is required to do in this particular case in the books of the acquirer. So in the books of the acquirer, that is in the books of A, he is required to do an acquisition entry. He is required to do an acquisition entry, and this is going to be done on the date of acquisition. Mind the words. So when A gets a control over the business of B, then A is required to do an entry. So in the books of acquirer, he is required to do an acquisition entry on the date of acquisition. Something similar to what you have done in Accounting Standard 14 in intermediate. Something on a similar lines, the acquisition entry would look like. So A in the books of accounts is required to do an entry on the date of acquisition. So let's have a look at how that entry looks like. A is going to put an entry that is assets will be given a debit and liabilities will be given a credit. So this is the fair value of all the assets and liabilities of B. Mind it. So A is going to put an entry where he's going to record the assets and the liabilities of B, and that's going to be taken at the fair value on the date of acquisition. And in this particular case, all the 100% assets and liabilities will be written out here. Let me tell you one thing, that when A gets a control over the business of B, for the purpose of control, it is not necessary that you get 100% of the shares. Control can come even if you get below 100%, you can get a 60% stake and you get a control. So it is not necessary that for the purpose of control, he gets a 100% shares in B. But nevertheless, irrespective of the percentage which A gets on B, in this entry, we are going to put 100% of the assets only. All the assets and liabilities of B is going to be recorded in this case, irrespective of the percentage A gets on B. Then what we're going to do, we will record the purchase consideration, and this purchase consideration is going to be given a credit. So A made a payment of a consideration to the shareholders of B, and this consideration is going to be given a credit in this entry. Now this purchase consideration could be, let's say for example, 70%. So let's say A got a control over the business of B, so he paid a consideration which is supposed to be 70%. Now you can see that there is a mathematical mismatch in the entry. The net assets which is recorded is to the extent of 100% and the purchase consideration is 70. So you are comparing 100% of the net assets versus a 70% of the consideration, and that becomes a mismatch. So what we are required to do at this stage, the remaining 30% is held by, as you saw in the previous class, that is called NCI. That's called a non-controlling interest. If A has got a 70% stake in B, then the remaining 30% is held by outsiders, and those outsiders are going to be called as non-controlling interest. So you can definitely see one thing on a mathematical level, that when you take the sum total of the purchase consideration and the NCI, it turns out to be a total of 100%. And when you see the net assets in that case, this also turns out to be 100% itself. So you can see that now you're comparing 100% of the net assets versus the purchase consideration plus NCI, which is also 100%, 70 plus 30. But still, there will be a difference in this particular entry, and I think you can definitely make a guess that this entry, the difference in this entry is going to be called as a goodwill if the difference appears on the debit side. And this is going to be per se called a capital reserve if the difference comes on the credit side. That's what you did in terms of amalgamation. Though I would define, this capital reserve later with a different term. I'm going to call this as a bargain purchase gain. We'll do a little more discussion of that later, but as of now, you can say, yes, any difference in this entry is attributed as goodwill or capital reserve. So moral of the story, let's, I think, map up the concept at the back of the mind. So when you are able to reach a conclusion that A gets a control of the business of B, then A on the acquisition date, the acquirer on the acquisition date is required to do an acquisition entry. And this acquisition entry, as I said, looks something like an amalgamation, accounting standard 14 in your intermediate days, where you are going to record the assets and liabilities at fair value 100%, even though you get a percentage voting power below 100. Because once you get a control over the company, we are going to do a full consolidation. And if it is going to be a full consolidation, you are required to capture 100% of the net assets. Against that, you paid a consideration. So that's say 70%, 30% becomes NCI. Any balancing figure in this entry is a goodwill or a capital reserve. Now, based on this entry itself, trust me, I am going to give you a 7-step model, because every element in this entry will be computed with the help of a separate note, which I call it as a 7-step model. Now see carefully as I give you the 7-step model which we would apply. So for the purpose of acquisition accounting, we are going to follow a 7 steps in this particular case. So what I'm going to do, every element carefully. Step number 1. In the step number 1, we need to identify what we call the accounting acquirer. In the first step, we need to identify who is the accounting acquirer. Now you'll say, what's the big deal in this? In this case, sir, we can easily say that A is the accounting acquirer. No, A is not the accounting acquirer. Let me tell you that in this case, we can say A is the legal acquirer and B is supposed to be the legal acquiree because he is acquiring a control on the face of it. But let's say, for example, if it turns out to be a reverse acquisition, which you saw in the previous class, if this turns out to be a reverse acquisition, A, who is the legal acquirer, will become the accounting acquiree. And B, who is the legal acquiree, turns out to be the accounting acquirer. So it is not necessary. Yes, if it is a normal case, not a reverse acquisition, the legal and accounting acquirer is same. So there will be a need to identify that is the legal and the accounting acquirer the same people or not. Because typically when it turns out to be a reverse acquisition, so in this particular case, the person who is acquirer from a legal perspective becomes an acquiree from an accounting perspective. Now, how do you identify those inputs and all? We're going to study that in detail in step number 1. How do you identify who is the accounting acquirer? So the focus is getting the accounting acquirer. And why? Because you need to put this entry in the books of the acquirer. The reason of doing the step number 1 is this entry is done in the books of the accounting acquirer. So unless you know who is the accounting acquirer, I will not be able to record the entry. My second step would be to identify the date of acquisition. The second step would be to get my DOA, that is the date of acquisition. Because this entry is going to be done on the date of acquisition. Now you would say, what's the big deal in terms of date of acquisition? Yes, in a larger question, the acquisition date will be very clearly given in the question. But there could be certain considerations which we need to consider in order to evaluate that what is the date of acquisition. So since this entry is required to be done on the date of acquisition, that becomes my step number 2. So we're going systematic because whatever we need to organize, in whose books, step 1, on which date is step number 2. Then I come to the step number 3 and I'm going to organize the list of all the net assets which are acquired. So we need to organize the list of the net assets, and since you are going to record the net assets in this particular entry, it is necessary to organize the list of the net assets as well. Wow. So my step number 3 will be organizing all the net assets which needs to be incorporated in this entry. That is step number 3. Then let's go to the step number 4. In terms of the step number 4, I will get the purchase consideration, and you can see that very clear. My step number 4 will be organizing the purchase consideration. You can guess what my step number 5 is going to be, which is calculating the non-controlling interest, which is another component in this entry. Superb. And trust me, my step number 6 will be getting that goodwill capital reserve, which is a balancing figure, but we can compute it as well. So my step number 6 is going to be the calculation of the goodwill, or you can say the bargain purchase gain, what we are calling it as a capital reserve. So getting this goodwill, or you can say the bargain purchase gain, is the step number 6. Very systematic. Yes, step number 1 is getting the accounting acquirer. Yes, step number 2 is getting the acquisition date. Yes, step number 3 is getting the net assets ready. Step number 4 is purchase consideration. Step number 5 is NCI. Step number 6 is goodwill and capital reserve. And what is the step number 7? This entry itself is my step number 7 in this particular case. My entry is the step number 7. I'm going to organize all these inputs together and put them in this particular entry. So once you put all these elements in this particular entry, you get the acquisition entry. So at the end of it, we are basically trying to pass this entry. And all these 6 steps will help you to put this entry as well. So one thing let's get this very clear. When you go to get a larger question, the best way to attack the question is go on a systematic level, step-by-step approach. In which particular case, you are going to first of all identify accounting acquirer, acquisition date, because the entry is done in whose books? Accounting acquirer, not legal acquirer. The entry is done on which date? It is on the acquisition date. And in order to organize the entry, you need the net assets, the purchase consideration, the NCI, and the goodwill. So that is step number 3, 4, 5, 6. And then you consolidate everything and put this entry. I know what would be coming to your mind is also, so why are we putting this particular entry? What does this entry really serve me? All those questions will be answered later. Don't worry. As of now, I've just given you a basic technique in terms of the entry which you need to pass on the acquisition date. What is the role of this entry in terms of the consolidation? That's we're going to see later. Now, technically speaking, I've got 2 choices of proceeding with my inputs. One is that I give you a basic flavor of these 7 steps and I start doing bigger questions with you. Or the other one is that we start digging deep into each and every step and then we do larger questions. I think I want to pick up each and every step one by one. And I want to dig deep into each step. So when I confront a larger question, I know all the kind of complications which can arise at each step. Because in a larger question, the complications may not be pertaining to every step. But I think if you have the good knowledge in terms of every step, then I think the larger questions becomes easy. And before this, let me also tell you what kind of steps can you get independent questions. Because out of these steps, as I said, one kind of question is that you get a complete question on a comprehensive 7-step model. The other one is that you're given questions on certain areas. So the questions where, generally you can see there could be independent questions. Step number 3, you could definitely get some independent questions. The purchase considerations, the NCI, and the goodwill. So these are the 5 steps where you can get definite independent questions. I think acquisition, accounting, acquirer, and date of acquisition maybe, but I think the chances, if you look at the trend, the chances are more bright in terms of getting independent larger questions on step number 3, 4, 5, and 6. And as far as step 7 is concerned, it's nothing but it's a merger, you can say, of all the 6 steps we've done. I hope, friends, the mind is mapped. You are clear in terms of how the acquisition accounting is done. Yes, sir. First, we want to understand each step thoroughly. Yes, that's what we're going to do. We'll dig deep into each and every step one by one. So let's begin the journey with the step number 1 with you. So I am going to first come to the step number 1. Now, in terms of the step number 1, we said we need to identify what we call the accounting acquirer. So the idea is to identify the accounting acquirer. Now, when I look at the concept of identifying the accounting acquirer, what comes into my mind is again all the permutations and combinations. So I'm going to give you a wonderful permutation combination chart. We'll see questions also on that area, that what can be the different permutation combination. When we read the standard, it gives us an idea that the accounting acquirer is dependent upon 2 factors. The factor number 1 is that what is the form of consideration? When the acquirer makes a payment to the shareholders of the acquiree, what is the form of the purchase consideration? So that is one factor which could influence the accounting acquirer. Another factor when you read along is that did you create a new company in this particular business combination or not? So when the transaction is happening between the 2 companies, did they create a new company to, execute the transaction, or no new company is created. So I would say there are two factors which needs to be evaluated. Is a new company created in this deal or not? And number two, what is the form of the consideration? So that gives me a total of 4 permutations and combination. So I'm just going to make a quick mind map directly, telling you the various permutations, combinations which could arise. So I would say your focus points to begin with is going to be something like this. When you look at a question to identify the accounting acquirer, look at the factor number 1. Put a question to yourself that is a new company created or not. You need to put across a question, is a new company created or not? So the first thing you're going to focus in terms of the question is identify, is a new company created in this particular case or not? The answer is no, or the answer is a yes. So when you say no or when you say yes, then my focus is going to turn on another question. In both the cases, whether your answer is a yes or no, I am going to evaluate that what is the form of the consideration. So in this particular case, we'll further subdivide this in terms of 2 cases. So my focus now in this particular case will be, the next question is, what is the form of purchase consideration? And even in this particular case, I'm going to focus on what is the form of purchase consideration. So the first step is to identify that did you create a new company or not? And the second focus point is what is the form of the purchase consideration? So in this particular case, when you look at the form of the purchase consideration, the standard gives us basically 2 permutations and combinations. One is we can say that the consideration is primarily in cash. I did not say that the consideration is completely in cash. We said it is primarily in terms of cash. So we need to see that the consideration is mainly in cash, or is it primarily in equity shares. The consideration is primarily paid in the form of equity shares. Similarly, there also will get 2 combinations. The consideration is primarily paid in cash, or the consideration is primarily in equity shares. So these are the 2 permutation combinations which could arise in each case. Does this mean that we've got a total of 4 permutations and combinations as we look across? Yes. Mainly you're going to see a total of 4 permutation combinations. New company is not created, and the consideration is cash or the consideration is shares. New company is created, the consideration is cash or the consideration is in terms of shares. Now, let's watch this very carefully. See this at a logical front. I'm going to make a walkthrough on all the 4 cases. We'll do some questions also with you on these cases, but just make a logical walkthrough with me. Now, in this particular case, when I say no new company is created, let's say there is an existing company A and there is an existing company B, and A takes over the business of B. A acquires a control of the business of B. Now, let's ask a very simple question to ourselves. A Limited is telling the shareholders of B that I will give you cash to acquire the shares in your company. So A Limited is telling the shareholders of B that I will give you cash to buy these shares in your company. By giving them cash, do you think B becomes the shareholders of company A? No. Get this very straight. A is telling B Limited shareholders that I will give you a consideration in cash. If these people get a cash to sell their shares to A, in this particular case, the shareholders of B do not become the shareholders of A. And if they do not become the shareholders of A, there will be no dilution in terms of percentage. Get that straight. By making a payment in the form of cash, you are not making the shareholders of B the shareholders of A. So your percentage stake does not get diluted. If your percentage stake does not get diluted, that means A will continue to control the company. The shareholders of A who have got all the shares of A are still in control with all the shares of A. Nobody is given any equity stake in A. So in this particular case, if this is the case, we can say the legal and the accounting acquirer is of course the same. So in this particular case, we can undoubtedly reach a conclusion that the legal and accounting acquirer is of course the same. There cannot be a case of reverse acquisition. If your consideration is paid in terms of cash, then where is the question of dilution of your control? So it is not possible that the person, the shareholders to whom the consideration is given, they become the control of my company because I paid them cash. But now let's imagine that the consideration is in the form of equity shares. That flavor I gave you last class as well. If A tells the shareholders of B that I will give you ordinary shares in my company, then there are two possibilities. Let's watch this again. Let's, I think, have a look at this one. So I'm looking at the case when no new company is created. I'm looking at the case when no new company is created and the consideration is mainly in shares. The consideration is mainly paid in the form of shares. Let's have a look at the two permutations and combinations which can trigger in this case. I'm taking the same examples which I gave you in the previous class to prove that it's an acquisition or is it a reverse acquisition concept. So let's look at a very basic example. Let's look at two situations. So let's look at a situation number one, where there is a company A and there is a company B. And then we'll also look at another situation number two, where we'll see the same company A and company B. Now let's consider company A is the legal acquirer. Company A is the legal acquirer. He is paying a consideration to the shareholders of B. Now, let's consider the number of shares. Let's consider the number of shares in company A is, let's say, 100. And let's say company B has got 60 shares in his company. Now, A approaches the shareholders of B and tells them that I'll give you shares in my company as a part of PC, 1:1. He says, in order to acquire the shares in your company, I will give you shares 1:1, one share for every 2 shares held. So in this particular case, A lands up giving 60 shares to the shareholders of B. So the share capital base of company A becomes 160 shares because A is giving 60 shares to the shareholders of B. So when he gives 60 shares to the shareholders of B, you can say the total capital base of A becomes 160 and the shareholders of A have got 100 shares in the company. I'm just trying to look at what is the position post business combination. We want to see that what is the percentage post business combination. A, by giving the shares to the shareholders of B, will certainly dilute his own stake, because he is making the shareholders of Equity the shareholders in his own company. By making them shareholders in his own company, his share will definitely get diluted. Now they've got 100 shares out of a total capital base, which is 160 shares. And if you calculate the percentage, it comes to 62.5%. We can very clearly see in this particular case, the percentage is got diluted, but still A is in control of the company. By giving the shares to the shareholders of B, his percentage stake from 100% went down to 62.5, but we can say A is still in control. A is still in control of the company. If it is still in control, I would say the legal and the accounting acquirer in this case is same, because he did not lose control over the company. Since he did not lose control over the company, he is still supposed to be the acquirer. So legal and accounting acquirer turns out to be the same. But let's consider a reverse kind of a situation. Let's take the same example with the number of shares being the same, that is 100 as well as 60 shares. But let's say now the exchange ratio turns out to be much greater. A is telling the shareholders of B, I'll give you, let's say, 2.5 shares for every one. So you will notice one thing, that as A is going to give more shares against one share. Right now it was 1:1, but if he lands up giving more shares to the shareholders of B, he is willing to lose a control over his own company. So let's say he decides that I will give you 2.5 shares for every one. Don't worry on that decimal 2.5. So he is telling the shareholders of B that I'll give you 2.5 shares for every one share in your company, which means 150 shares to the shareholders of B. So if I look at the status post business combination, what is the percentage of A? Now the total capital base of company A is to the extent of 250 shares, because they've got a total of 100 shares already. And in this particular case, you are giving another 150 shares to the other shareholders as well. So they have got 100 shares out of the total capital base, which is 250 shares. Now, if you look at the percentage, so now in this particular case, if you look at the percentage, 100 by 250, it works out at 40%. You can clearly see in this particular case that A, after giving a consideration to the shareholders of B, has lost the control over his own company. He was 100% stakeholders of the company, and now they've got a 40% stake. So in this particular case, if you ask me that what has happened, that A has lost control. A is lost control over his own company. And if A loses a control, undoubtedly the legal and the accounting acquirer is not the same. When as a legal acquirer, you make a payment of the consideration and you lose a control over your own company, you are not accounting acquirer. So in this particular case, we can say that A is supposed to be the legal acquirer. A is supposed to be a legal acquirer, but he is supposed to be an accounting acquiree. He is supposed to be an accounting acquiree. Similarly, in this particular case, B, who is supposed to be a legal acquiree. From the legal perspective, he is a legal acquiree, but he is going to be called as an accounting acquirer from the accounting perspective. So this is what we need to be watchful on. So I think you'll get the mapping very clear in the mind that when A is giving the consideration to the shareholders of B in cash, you do not make them equity stakeholders in your company. So that can never lead to reverse acquisition. But if A Limited tells the shareholders of B that I will give you shares, in that particular case, once they get shares in your company, you lose a control. That is reverse acquisition. Your percentage dilutes, but you do not lose a control. Then the accounting and the legal acquirer remains the same. Right? I hope, friends, I'm very clear with the picture out here. Right? I hope I'm very clear with the picture out here that in this particular case, we are looking at the second permutation combination. And in this case, we said it all depends. I've already given you the two permutation combinations which would arise. So does this mean that every time the consideration is in the form of shares, we should calculate a post-business combination percentage? I would say yes. You calculate a post-business combination percentage and see, is the percentage getting diluted and still the control continues? Then it is acquisition accounting. And the percentage gets diluted to an extent that you lose a control, it becomes a case of reverse acquisition. So in this particular case, everything depends upon, you can say, post-business combination percentage. Your post-business combination percentage is going to be a deciding criteria. Claire, sir, you made it very much interesting. Thank you indeed. Okay, now let's have a look at another case as well, where in order to execute this business combination, a new company is created. Now watch this carefully. This could be a little more technical. So let's consider a simple example. Let's consider there is a company A Limited, which is an existing company, and there is a company B Limited, which is also an existing company. Now, in this particular case, they create a new company, C Limited. So this is a new company created, which will take over the control of A and B. So C Limited is a new company which is created to acquire a control over the business of A and B. Now, watch this again. C Limited tells the shareholders of A and B that I will acquire your shares and give you cash. I think it's again straight. If C is telling the shareholders of A and B that I'll acquire your companies and give you cash, the shareholders of A do not get equity stake in C. The shareholders of B do not get an equity stake in C. How can they get a control over C? So in this case also, if the consideration is paid in the form of cash, then also we can say outrightly the legal and the accounting acquirer undoubtedly in this particular case is going to be same. The legal and accounting acquirer cannot be different in this case. So one thing is very clear. I will put it outrightly like this, that if you are creating a new company or you're not creating a new company and the consideration is cash. So let's put it like this. If the consideration is in cash, then I don't care whether a new company is created or not. It cannot be a reverse acquisition. It'll always turn out to be an acquisition accounting. So in this case also it is acquisition accounting. In this case also it is acquisition accounting. Now comes the input. In this particular case, when the consideration is primarily in terms of equity shares. So I think let's do one thing. Let's take you to an example on this area as well. So let's consider the case when a new company is created. Let's consider a case when a new company is created and the consideration is primarily in shares. The consideration is primarily in terms of shares. Let's see this again in a little more detail at this stage. And then I'm going to make some quick statements to you after this area of discussion. Now we are focusing on the case when a new company is created and the consideration is paid in shares. So let's consider there is an existing company. Let's consider there is an existing company. A Limited is an existing company. B Limited is an existing company. And let's say a new company is created, and let's say a new company C Limited is created. Now in this particular case, C is going to allot the shares to the shareholders of A and to the shareholders of B. Now I'll just give a very simple example. You'll get the basic flavor immediately. Let's say this company is created with the total of 10,000 shares. So the company C is formed and it is created with a total of 10,000 shares. Now, as a part of the consideration, C issues, let's say, 6,000 shares to the shareholders of A. And as a part of the consideration, C issues a total of 4,000 shares to the shareholders of B. Indirectly, what does this mean? That when A shareholders are going to get 6,000 shares in C, they are getting a 60% stake in C. And when they're getting 4,000 shares, they're getting 40% stake in C. Now imagine if the shareholders of A are getting a 60% stake in C, then who is in control of the company C? A is in the shareholders of A are in the control. By getting a 60% stake, they get control over C Limited. If you logically see, these are again legal acquirees, and he is supposed to be a legal acquirer. C is created in order to acquire A and B, but in this case we can say C is the legal acquirer and they are supposed to be a legal acquiree, but A is getting a control over C. So A, who is the legal acquiree, becomes the accounting acquirer in this case again. So I would put it like this, that in this particular case, A is getting a control. So we can say he is a legal acquiree. From the legal perspective, he is a legal acquiree, but from the accounting perspective, he becomes an accounting acquirer as well. This is again undoubtedly a case of a reverse acquisition as well. And let me again make a little more stronger statement at this stage. If you're creating a new company, can I say somebody of the two companies A and B will definitely get control over the company C? Because if the shares of C are given to the existing companies A and B, one of them will definitely get a majority shares in C. And the person who gets a majority shares in terms of C is going to get control over C. So which means C is not going to be an accounting acquirer at all. I think there is a huge possibility, almost I would say 100%, that if this is the case when a new company is created, one of the existing companies will definitely become the accounting acquirer. I'm making a strong statement. I'm saying you will see that one of the existing companies will definitely become the accounting acquirer. So it's going to be turned out to be a reverse acquisition for sure. Because one of the shareholders will definitely get a majority shares in the other company. So whosoever gets the majority shares, we can say he becomes the accounting acquirer. So moral of the story, I'll put it out here in this particular case, that in this particular case, we can say generally, I'm making a strong statement in saying generally, it is a case of reverse acquisition. You will not find that the legal and accounting acquirer is the same. Generally, it would be a case of a reverse acquisition. So I think I have now some inputs ready with me in terms of the step number 1. Now, look at this chart and let me make 3 consolidated inputs to you at this stage and vouch me. Can I say number 1? Can I say number 1? If the consideration is in cash, you need to vouch me a yes or no on that. Can I say if number 1, the consideration is in cash? I don't care whether a new company is created or not. It is always a case of acquisition accounting. Agreed. If you say the consideration is in cash, I don't care whether a new company is created or not. So in this particular case, what do you say? Can I outrightly say that this will always be an acquisition accounting? The consideration is in cash, whether you create a new company or you don't create a new company. In this particular case, it will always be acquisition accounting. That's rightly agreed. Second statement, if new company is not created, if new company is not created and the consideration is in shares, it can be acquisition, it can be reverse acquisition. You need to evaluate based on the percentage post-business combination. Correct? You need to make your evaluations based on the percentage post-business combination. It may be acquisition, it may be reverse acquisition. All the status depends upon the post-business combination percentage. That's right. And can I say the third case is when a new company is created and the consideration is primarily in shares, highly likely to be a reverse acquisition. I said in this particular case, highly likely that this would be a reverse acquisition. That's wonderful indeed. So I think my step number 1 is taken care. We need to do some questions now on this area. Let's, I think, take you to some questions. There is a question in the study material. So I'm going to first take you to the question which is there in the study material on this area. So let's go to the study material. I've taken that question from the study material as well. Let's have a look. We will first read the question carefully, illustration number 5. And after reading the illustration, we will evaluate which case are we falling in. The first thing you need to do, you need to identify the case we are falling into. That's brilliant. So I will carefully read the facts and we need to see that is it a case when new company is not created or created. The consideration is primarily in cash or shares. See which four case it falls in, then we'll decide. It says Veera Limited and Zira Limited are both in the business of manufacturing and selling lubricants. So one thing is very clear, that these are both existing companies. These are definitely existing companies because they're already in the business of selling lubricants in this case. The shareholders of Veera and Zira agreed to join forces to benefit from lower delivery and distribution cost. The business combination is carried out by setting up a new entity called Mira. So we can very clearly see that Mira is supposed to be a new company which is created. So one thing is very clear, that it is not a case where a new company is not created. It is a case where a new company is created. Now we just need to see the consideration is in what form. And then it says it issues 100 shares to Veera and 50 shares to Zira's shareholders in exchange for the transfer of shares in those entities. I think I just want to first of all have a little look as well. So this is Mira M, this is Veera, and this is Zira. Now what is happening in this particular case, Mira is issuing shares to Veera. He is issuing 100 shares to Veera and it is issuing 50 shares to Zira. I don't think so. I need to tell you that is this a case of reverse acquisition or not? You tell me. So we can see that a new company is created, that's one, and the consideration is primarily in terms of shares, that's two. So what do you think? Do you think it turns out to be a reverse acquisition in this case? Think.
Yes, sir.
Wonderful indeed. It's a clear-cut case in this case. That's right. So we can say he is getting 100 out of 150. That is supposed to be 2/3, or we can say 66.67%. And he is getting 50 shares out of 150. That makes it a total of 33.33%. So Veera is getting a control over the new company, Mira. Let's, I think, still read. The number of shares reflects the relative fair values of the entity before the combination. Also, the company's shareholders gets the voting rights in Mira based on the respective shareholding. Now, since the voting rights are based on the shareholding pattern, which means the entity which gets the largest voting power will be in a position to do decision making. You're going to see in Index 110 later that control assessment generally is based on a voting power, and there is undoubtedly a presumption that if you're a majority stakeholder, by default you get a control. Determine the acquirer by applying the principles of Index 103. So I think I'm directly going to the answer without reading the details out here. So we can say Veera Limited shareholders gets a 67%, rounded up to 67, that's 100 by 150 shares. And Zira gets a 33% stake, hence Veera Limited is the acquirer. So we can say, hence Veera is the acquirer. This is the accounting acquirer. Undoubtedly, it is a case of a reverse acquisition. Legal acquirer is Mira, but accounting acquirer is Veera. Super. That was a good question indeed. Illustration 5 in the study mat. Okay, I've also taken another question which is also in the study material as well, but I just wanted to take up the diagrammatic view. So I've taken another small little question out here with two parts out here. This is a question which is there in the study material also, and it's given in the education material also. So I just took this question because, there is a wonderful diagrammatic representation also to give you a little feel of the concept. Let's now look at two parts. Two parts are independent parts. Both the parts are independent. We'll read, identify the case, and look at the permutations combination. It says ABC Limited is incorporated a company super. ABC company incorporated a company super. What is coming to the mind is new company is created. to acquire 100% shares of another company, Focus, and therefore to get a control over this company. So what is given in this particular case? There is a company ABC, and this company ABC creates a new company that is Super. A new company is created. Then he says, to fund the purchase, Super acquired a loan from XYZ Bank at a commercial rate of interest. The loan funds are used by Super to acquire the entire shares of Focus at a fair value in an orderly transaction. Now, in this particular case, the company Super took a loan, got the money in cash, and with that cash, it paid the consideration to the shareholders of Focus. So what is the form of the consideration? What do you say? He's acquired a loan, and there is with this loan acquired the stake. So can I say the consideration is primarily in cash? The consideration in this particular case is primarily in terms of cash, because he first took a loan and then after taking this, he made acquisition of shares. That's great. Then he says, post the acquisition, Super has got the ability to elect or appoint or remove the majority members of the governing body. Now, we'll see that in Indus 110 also later, that in order to get a control of the company, you should also be in a position to appoint and remove the key management personnel in the company. So in this particular case, he's also giving you insights that Super Limited post-acquisition will be in an ability to appoint or remove the key members, the key management personnel of the company. And Super is in the power where it will be able to dominate the management of Focus. Can Super Limited be identified as the acquirer in this business combination? So what is the permutation combination? A new company Super is created and the consideration is primarily paid in cash. Is this a reverse acquisition or is this a normal acquisition accounting? You tell me.
Normal
We created, sorry, but I missed you.
acquisition accounting.
Absolutely correct. So we can say, since a new company is created, but the consideration is primarily in cash, we can say, yes, it is a case of acquisition accounting, not a reverse acquisition. So undoubtedly, Super is definitely legal and accounting acquirer both. Super. Now let's look at a little more complicated question with you. This is an interesting question. This is there in the study material as well, but I wanted to take, both the questions. So I thought I'll take that from the education material. The second part of the question, this is from the education material, is there in the study material also. It says to capitalize on economies of scale and another synergy, entity Q contributes its wholly owned subsidiary, entity X, and entity R contributes its wholly owned subsidiary, entity Y, to a newly incorporated company that is Super Limited. Now, let's understand one thing. The language could be technical to understand. What is happening in this particular case? There are two companies, and the two existing companies are entity Q as well as entity R. There are two existing companies. So let me put it like this to diagrammatically visualize it well. So there are two existing companies, to put it like this. So we've got two existing companies. One is the company Q and one is the company R. Now, company Q has got a subsidiary X. So he's got a 100% stake in X, and company R has got a subsidiary Y. So what they did, they are willing to pass on the shares of X to another company. The company R is willing to pass on the shares of Y to another company. So they're contributing means they are passing on the shares, they're passing on their subsidiaries to another company. And what is that other company? The other company which is created is called Super. So this company Super is supposed to be a new company. So what is the transaction happening? The transaction which is happening in this case is Q approaches Super and says, I'll sell you my subsidiary X. I'll give you my subsidiary X, you give me shares in your company. The company R also approaches and tells Super that I will give you my subsidiary Y. So Q is selling the subsidiary X and getting shares in Super. R is selling the subsidiary Y and getting shares in Super. So they are giving the shares in their subsidiary, passing on the fully owned subsidiaries to Super Limited in lieu of getting shares in the company Super. Now let's see. So what it adds on out here is, it says to capitalize on the economies of scale and another synergy, Q contributes, which means he's selling. Entity Q contributes its wholly owned subsidiary entity X, and entity R contributes its wholly owned subsidiary Y to a newly incorporated company Super. So one thing is very clear, that a new company is created. I am thinking without even reading much. If the consideration is paid in shares, can I undoubtedly call it as a reverse acquisition? What do you say?
Yes,
Sure.
sir.
Wonderful indeed. So we can see further. It says that Super issues 200 shares to Q and 100 shares to R in exchange for transfer of shares in the respective subsidiary. Now, what is given in this particular case? The company Super gave 200 shares to Q and the company Super gave 100 shares to R. So can I outrightly say that he's getting 200 by 300, he's getting a 67% stake. He's getting 100 by 300, he's getting a 33% stake in Super. So who is getting a control over this company? Q. So we can say this is undoubtedly a reverse acquisition. Q is the legal acquiree, but he's going to be an accounting acquirer. So let's see further. The number of shares reflects the relative size of the entity before the combinations. And now you can see the inputs. This is before business combination. Q is got 100% subsidiary X. R has got 100% subsidiary Y, which I've already created. Now, entity Q gets a 67% stake in Super. Entity R gets a 33% in Super. So we can say entity Q is supposed to be the accounting acquirer, though he is a legal acquiree, but he is an accounting acquirer, indicating it is undoubtedly a case of reverse acquisition. So it says, can Super be identified as the acquirer in a business combination? No. And apply acquisition accounting in consolidation? No. If Super is not the acquirer, then which entity is considered as the acquirer? So we've already said entity Q is going to be the accounting acquirer. And how should the accounting combination be accounted for? We're going to apply reverse acquisition accounting in this case. Super. So I think we've done all the permutation combinations. I have basically given you all the, combinations which could occur in terms of step number one. I hope we are absolutely 100% clear in terms of step one. Now we need to go to the step number two. Let's go further. So I am now going to take you to the inputs in terms of the step number two. So let me just take you to the step number two. So now let's come to the inputs in terms of the second step, which is a part of my 7 steps, which is identifying the acquirer. Now, anybody would think, what's the big deal in terms of identifying the acquirer? I'll just give you some plain vanilla inputs, but we'll work a little more upon this further. On a very apparent level, if you get larger questions in the exam, trust me, the question will definitely give you the facts that what is the date of acquisition. But let me now tell you one thing very interesting to watch. So when I'm looking at the date of acquisition, When I'm looking at the date of acquisition, let me now tell you one very interesting input. I'll just use an interesting term, which is used in the standard as well. There are two terms. One is called acquisition date, date of acquisition, and one is called a closing date. Please hear this very carefully because this can be a very crucial point to understand. So I'm saying basically there are two dates which are coming to my mind. So one is, I would say the date number one is called a date of acquisition. And the second date what comes to the mind is called a closing date. It is called a closing date. Now let's first understand what is a difference between a date of acquisition and a closing date. A date of acquisition means the date when we get control. Date on which control comes. So when you get control over a particular company, that is called a date of acquisition. That is when you're getting a control over a particular company. But when you say closing date, it is the date when purchase consideration is discharged. It is the date when the purchase consideration is discharged. So let's get this very straight. We'll take examples also to understand this in a good detail as well. But let's first get this clear. So there are two dates which I'm putting in your mind. One is called a date of acquisition. So date of acquisition is the date when you get a control. So the date when you get a control is acquisition date. When the purchase consideration is discharged, that is called a closing date. Generally, the two dates are same. Generally, you will see that the date when you get a control is the date when the consideration is discharged. But can you get a control before you discharge the consideration? In certain cases, yes. So what we are saying that generally, So what we are saying is that generally, these two dates are same. Generally, we're saying that these two dates are same. The date when you get a control and the date when the consideration is paid is same. But can these dates be different? Can a company get a control before the consideration is paid? Can the date of acquisition precede the closing date? Yes. So what I'm putting as an exception now, the exception in this particular case is can acquirer get control? Can acquirer get a control before PC is discharged? Before the purchase consideration is discharged? So we're looking at the fact that can there be an exception? Is it possible that you get a control but the purchase consideration is not discharged yet? And the answer is a yes. So the question rises, what is that case? What is the case where you can say the control is acquired even before the the consideration is paid? And that is only when there is a binding sale agreement. So when there is a binding sale agreement between the acquirer and the acquiree. So you need to see that is there a binding sale agreement or not. So in those cases, if the agreement is binding, it will occur irrespective. So we can say that the control can precede the closing date, and in those cases, we will say the date of acquisition is before the closing date. Let's put it again. We'll see questions on that area, no worry. So what is coming to the back of the mind in terms of step number two is, we're looking at what is a date of acquisition and what is a closing date. The two terms are generally used interchangeably, but there is a technical difference. When you say it is a date of acquisition, it is the date when you get a control. And what is a closing date? The date when the consideration is paid. Generally, the date when you get a control is the date when you pay the consideration. But sometimes, due to a binding sale agreement between the two companies, acquirer, acquiree, they agree that consideration is paid later, but the control is going to pass on before the purchase consideration is paid. So in every question now, what are you going to do? You're going to start digging in terms of identifying, is the closing date, acquisition date same? Or is the acquisition date preceding the closing date? Let's look at questions now. I'm going to take you again to the study material, and there are some interesting questions which are given on this particular area. Illustration number 7, illustration number 8, and illustration number 9. So we're going to carefully look at the facts of the case and decide what is the case in this case. So let's have a read on the illustration 7. Can an acquiring entity account for a business combination on the basis of signed, non-binding letter of intent where the exchange consideration and other conditions expected to be completed within 2 months? There are 3 inputs. It's a signed letter of intent, but non-binding in nature. Non-binding in nature. Do you think, considering non-binding, do you think the date of acquisition can proceed? Can it precede? Can it precede the closing date? Can I say the control is achieved before the consideration is paid? Your inputs on that.
No.
It's a signed letter, non-binding. Hanji beta.
No, sir.
That's rightly said. Of course, no, because the exception is on a binding letter. If it is not binding, the date of acquisition cannot proceed in this particular case. So the answer is a big no. As per the requirement of the standard, a non-binding letter of intent does not effectively transfer the control, and hence it cannot be considered as the basis of acquisition date. So unless in this particular case the consideration is paid, the closing date happens, you cannot consider the acquisition date. Let's see the next one. It says, illustration number 8, on 1st April, X agrees to acquire the shares of B in an all-equity deal. So it's going to be a consideration paid, shares in shares. As per the binding agreement, X will get the effective control on 1st April. Now let me tell you one thing. Don't get enamored with the fact that the word binding agreement is given, because sometimes the word binding agreement is given, but still it may not pass on the effective control. So you cannot say that the word binding is given, let me say that the control is transferred. Not necessarily. However, the consideration will be paid only when the shareholders' approval is received. So this agreement is subject to the shareholders' approval. Now we need to see that the shareholders' approval is something which is major or just a mere formality. The shareholders in its meeting scheduled is going to happen on 30th April. If the shareholders' approval is not received for issue of new shares, the consideration will be settled in cash. Let me say something. We are saying that the shareholders' approval is required to issue shares, and if the approval is not received, I'll settle the transaction in cash. So can I say that the deal will definitely happen irrespective the shareholders approve or not? It's only the form of the consideration will change from shares to cash. Am I right? So we're only saying that in this particular case, the deal is bound to occur. The shareholders' approval will only decide the form of the consideration, because in this case, if the shareholders approve, the consideration is in shares. If they do not approve, the consideration is cash. Which means in this case, the approval is not something which is major. The approval is something which is, you can say, mere formality in nature. Let's see. So the acquisition date in this case is 1st April, which is before the payment of consideration. This is because in the above scenario, even if the shareholders don't approve the shares, the consideration will be settled by payment of cash. My mind is now working on something like this. Watch me. Can I say your date of acquisition is generally going to be the date when the consideration is paid? And there is an exception that if there is a binding agreement, then I would say it depends. If the binding agreement is a mere formality, then the date of acquisition can precede the closing date. But if the binding agreement is subject to approval, which is substantive in nature, then it cannot proceed. Am I thinking correct? What do you say?
Yes, sir.
Absolutely. Let's look at illustration 9 on the other one. ABC acquired all the shares of XYZ. The negotiations commenced on 1st January X1 and the agreement is finalized on 1st March X1. While ABC obtains the power to control on 1st March X1, the agreement states that the acquisition is effective from 1st January X1 and that ABC is entitled to all the profits after that date. In addition, the purchase price is based on the net asset position on January X1. Interesting. It says ABC acquired all the shares of XYZ. Negotiations began on 1st March. While ABC is going to get a control on 1st March, the agreement states that the acquisition is going to be effective retrospectively. Even the calculation of the consideration is taking place on 1st January X1. But do you think my acquisition date can be 1st January X1? What do you say? Your control is coming on 1st March, but the agreement tells you that it is going to be effective retrospectively. Do you think before the control is acquired, I could consider the acquisition date? Of course not. So in this particular case, the acquisition date would of course remain 1st March because the concept is very clear. The power to control is arising on 1st March, even though the agreement says that you're going to get a retrospective effect. It doesn't make a difference. The agreement cannot say and override the concept of the date when the control arises. So it would remain on 1st March itself. Okay, now there is something more interesting which is there. So this is illustration number 10. This is going to be giving you inputs on the binding agreement. Then I think I'll just add a small little term also, small little chart on the step number 2. It says ABC and XYZ are manufacturer of rubber components for a particular type of equipment. ABC makes a bid for XYZ business and the Competition Commission of India, CCI, announces that the proposed transaction is going to be scrutinized to ensure that the competition laws are not breached. Even though the contracts are made subject to the approval of CCI, ABC, XYZ mutually agree that the terms of the acquisition and the purchase before the clearance of the CCI is obtained. So the scheme needs an approval of the Competition Commission of India. But they mutually agreed between themselves that we will execute everything. Can the acquisition date in this situation be the date when they mutually agree, even though the approval of the commission is awaited? So what do you say? And it says, assume that the approval of the commission is substantive in nature. Do you think in this case we can consider the acquisition date precedes the date of closing date in this case?
No, sir.
Absolutely makes sense, because in this particular case, unlike the previous illustration number 8, where the shareholders' approval was a mere formality, in this particular case, the formality is not there, it is substantive, because if this approval doesn't happen, the scheme cannot go ahead. So in this particular case, it is outrightly cannot be preceded. So, oh my God. This happens when you speak a little technical indeed, you know. I hope the file has got saved. Anyway, in the meantime, let me just, I think, consolidate the inputs. I'll make a quick chart on my step 2. I would say the acquisition date and the closing date generally is the same. That's 1. Secondly, I am looking at the inputs that are there any exceptions? Yes, if there is a binding agreement, the acquisition date can precede the closing date, but the status of the binding agreement depends upon if the binding agreement is subject to approval, you need to see that is the approval substantive or is it a mere formality? Let me, I think, document this part. So I'm just going to add something on the step number 2 at this stage. So this input is done. Let me just add something more at this stage. So we can make a quick inputs in terms of, you can say, a flow chart. Let's make a little flow chart. Just I give you in step 1, flow chart in terms of the step number 2. So I'm just giving you a quick flow chart in terms of the step number 2, so that we are very clear in the mind. How do we proceed at the acquisition date? So we can say generally. We can say generally. We can say the date of acquisition is same as a closing date. So we can say the acquisition date is the same as the closing date. We already know the date of acquisition is when you get a control, and the closing date is when the consideration is paid. But we can say that there are exceptions. We can say, yes, there are exceptions in this particular case. Now let's see those exceptions in this case. So when you're looking at the exceptions, I can say we need to see if there is a binding agreement. We need to see that there is a binding agreement in this particular case. So we need to see that is this binding agreement subject to approval. We need to see that the binding agreement is supposed to be subject to approval in this particular case. If you remember, illustration 8, it was subject to approval. Illustration 10, it was subject to approval. It was a binding agreement. So in this particular case, we can say there are 2 permutations combination. Non-binding, of course, we are not considering. So if it is subject to approval and the approval is a formality, the approval is mere formality. So you need to see that the approval is a mere formality, or we can say the approval is substantive, or we can say the approval is something which is major. It is substantive in nature. So in this particular case, we can say if the approval is something which is a mere formality, it can proceed. We can say the date of acquisition can precede. The date of acquisition can precede a closing date. In this case, the date of acquisition cannot precede. The date of acquisition cannot precede the closing date in this particular case. So I guess if I want to give a reference in terms of the question number, this is a case of illustration number 8 of the study mat. And if you want to look at this, this is a reference to illustration number 10 of the study mat. This is how you can make your mind maps as well, which is going to give you a lot of consolidation towards the end so that you are able to look at the inputs and remind you the inputs. And in terms of the binding agreement, we saw an example on a non-binding agreement. And on the non-binding agreement, we saw the concept of illustration number 7. So illustration 7 was giving a devotion on non-binding. Illustration 8 and 9 is a binding. But the moral of the story which I want to emphasize is that if there is a binding agreement, it's not the end in itself. If it is a binding agreement, you need to see that the binding agreement, if it is subject to approvals, that would decide the fate. Simply the presence of binding agreement is not enough. You need to see that this approval which is required is a formality or is it substantive. If it is a formality, you will fall into the exception. But if it is not a formality, you are not going to fall in the exception. Right, friends, so far so good. I guess my step number 1, my step number 2 is pretty much clear. Let me just get your comfort zone scores on a scale of 10 regarding the comfort zone on the step 1 and step 2. Nothing too technical, but let's still get your comfort zone scores. Wonderful indeed, 10 by 10, that's great. Now I am going to take my discussion forward. And I'm now going to give you a step number 3, which is going to be a little technical indeed, because now from here we are going to take a little jump in terms of the concept. Because as a part of the larger question, the step number 1 and 2 will never pose a problem, because you'll be able to easily identify whether it is acquisition or a reverse acquisition, and getting the acquisition date would also not be an issue. But I think now comes the step number 3, where I need to first map your mind. And I need to take you to a very interesting chart as well. So watch me carefully. The next 10 minutes are going to be quite crucial indeed. You will be able to get a larger concept, and we're going to work a lot on step 3. So we are going to work almost now for the entire remaining class on step number 3. Oh my God. Now watch this carefully. I am looking at the step number 3. Before I show you a particular chart, I need to first get the things very clear at the back of the mind. Conceptually get this very clear. There's a very interesting chart. I think let's just, show you the chart before we discuss the inputs. There is a chart in the study material. It's a very good chart which summarizes the entire aspects in this particular case. You must have a look at this particular chart, then I'll go back and explain this. Wow, you must see the colorful chart which is there. So just have a look at the chart. Don't get scared on this, but you just need to appreciate the bit. I'll be basically concentrating in terms of this particular chart, in terms of step number 3. Let's have a look. You can see that the heading is telling you exceptions to the recognition and the measurement principle. I'll not read further, but let me now map your mind. It says it is exception to recognition and measurement principle. I would say there are 3 exceptions. Exceptions to recognition principle, exceptions to measurement principle, exceptions to recognition and measurement principle. Sir, but what is the recognition principle? What is the measurement principle? No worry, we'll see. But you can see the recognition exceptions, you can see the measurement exceptions, and you can see both the recognition and the measurement exception. I'm just mapping things in the mind. I'm saying there are recognition exceptions. What is recognition? We'll see. There are measurement exceptions, and there are recognitions and measurement exceptions. I'll come back to this slide. Let me just come back on the agenda and explain what is the concept of recognition and measurement exception. Now, let's consider one thing and visualize this very carefully. In the step number 3, when I'm looking at the list of the net assets, my mind is now working like this. This is, let's say, the balance sheet of acquiree. Let's say this is the balance sheet of the accounting acquiree. And I'm looking at the acquisition entry. I'm looking at the acquisition entry in the books of acquirer. I'm looking at the acquisition entry in the books of the acquirer. Now, let me first tell you a few things. Please hear this carefully in order to understand the concept of the chart. Let's take a T-shaped balance sheet for just a mere understanding. Let's consider a T-shaped balance sheet out here. And the entry which you pass is supposed to be net assets. Let's take the assets and liabilities separately. So as a part of the acquisition entry, you take assets, debit, and you consider the liabilities, credit, etc. Now, let's get one thing very clear. I'm going to use some words. Please hear this carefully. So we've got some assets here, and we've got some liabilities here. These assets are appearing at a book value. These liabilities are appearing at a book value. And these assets and liability are supposed to appear at a fair value. Please, let's get this clear. So the assets and liabilities in the acquiree's balance sheet are at a book value, and they need to be incorporated in this entry at a fair value. They are to be incorporated at a fair value. So what is the measurement principle? The assets and liabilities are to be incorporated at a fair value. So if they're not incorporated at a fair value, that is called a measurement exception. So what is the measurement exception? The assets and liabilities are to be recorded at a fair value. So what is the assets and liabilities in this balance sheet will be recorded in this entry at a fair value. If they are recorded other than a fair value, it's called a measurement exception. Because you need to measure them at a fair value, and if you land up recording them at other than a fair value, it's a measurement exception. Number one. Number two, what is recognized here will also get recognized here. Mind the words carefully. What is recognized here will also get recognized here. But is there a possibility that what is not recognized here still gets recognized there? What is recognized in the balance sheet of the acquiree is appearing in the acquisition entry, but is there a possibility that what is not here appears here? That is called recognition exception. Aha, so I think we're getting the feel. So I can say what is recognized here appears here. What is not recognized here still appears here. Recognition exception. What is measured at a book value is taken at a fair value, but what is measured at a book value is recorded other than a fair value. Measurement exception. And the third is what is not recognized here gets recognized here other than a fair value. Recognition and a measurement exception. So can you just take some example? I'll do that as well, but first see me carefully. Let me just get the inputs clear. Considering this input, what I am now trying to visualize is a simple little inputs. Let's consider a simple little inputs at this particular stage. Watch this carefully. I am now just going to give you some basic inputs to understand the entire inputs. This is balance sheet of acquiree. And this is acquisition entry in the books of acquirer. And I want to give remarks. Now watch this carefully. You'll get the inputs. Number one, I'm putting a question. Is it appearing in the balance sheet of the acquiree? Yes, it is appearing. It is appearing at a book value. Will this appear in the acquisition entry? Yes, and it'll appear at a fair value. What is here appears here. Mind the words. What is here appears here at a fair value. This is the basic principle. This is the basic principle we have got. That what appears in the balance sheet appears in the entry. What is recognized here is recognized here, and it is taken at a fair value. जो उधर है वो इधर है. It is recognized at both places and at a fair value. Basic principle. Now watch this. Now what's this inputs in this case? I am now looking at, is it recognized here? Yes. And it is recognized here, yes, but not at fair value. But not at fair value. When you say it is not at a fair value, measurement exception. This is called measurement exception. So what is there in the books of the acquiree is in the entry as well. Yes, yes, but not at a fair value. Not at a fair value. This is called measurement exception. This is one funda which we need to understand. So we need to understand which assets and liabilities will fall in this measurement exception. Let's see another one. So I'm now looking at that it is not there. It is not there. But will it appear here? Yes. And it'll appear at a fair value. So what is the focus point? It is not there, but it is appearing here. Not recognized, but to be recognized. So if it is to be recognized, this is called recognition exception. Did you get the point? I hope, friends, you got the point now. So what is already recognized is coming here, but other than a fair value, measurement exception. What is coming, not coming here, but appears here at a fair value, recognition exception. Now see the fourth combination. It is not appearing here, but it will appear here at other than fair value. It is going to appear other than fair value. So what are the two cases? Not here, but appearing here, other than a fair value. So it is supposed to be recognition plus a measurement exception both. It is a recognition and a measurement exception both. I hope the chart is absolutely clear at this stage. So my mind needs to be very clear that when I am recording the acquisition entry, my basic thumb rule is what appears in the balance sheet of acquiree appears in the entry. What is in the balance sheet of acquiree appears in the entry and at a fair value. Basic principle. What appears in the balance sheet is taken other than a fair value. Measurement exception. Because you are required to measure at fair value. If you take other than fair value, it's a measurement exception. So when you say it is not there, but I will take it, it's not there, but I will take it. If you take it at fair value, recognition exception. If you take it other than a fair value, recognition and a measurement exception. So they've got three lists of items. So we need to see that what are the recognition exceptions, what are the measurement exceptions, and what are the recognitions and measurement exceptions. So I'm now going to go back to the chart and elaborate on what are the kind of exceptions. We'll start working on these exceptions with you one by one. Let's now come back to the input. Let's now read what is stated out here. It says limited to acquisition date accounting, an asset or liability which otherwise would not have been recorded gets recorded, which is not recorded gets recorded, not in the balance sheet of acquiree gets recorded in the acquisition entry. That is called a recognition exception. So there is only one exception, that is contingent liability. But we'll see this in detail. There is only one recognition exception. The contingent liabilities are not in the balance sheet of the acquiree, but they might enter the acquisition entry at a fair value. This is one exception which is given. Second, the assets and liabilities are measured at a value other than the acquisition date fair value. So that is called a measurement exception. And when you look at the measurement exceptions, in this particular case, the measurement exceptions, we are given a line below. It says exception number 1, share-based payments. Exception number 2, assets held for sale. Exception number 3, reacquired rights. Exception 1, exception 2, exception 3. Now don't get worried on what are the inputs within the exception, that we'll see. So, but we've got share-based payment as one exception, reacquired rights another exception, non-current assets held for sale as another exception. And then recognitions and the measurement exceptions both. What is not in the balance sheet of acquiree is going to appear and is going to appear other than a fair value. So we've got exceptions. One is income tax, exception 1, employee benefits, exception 2, indemnification assets, exception 3, and the lessees in which acquiree is a lessee, exception 4, which is pertaining to Ind AS 116. So we can say 1 plus 3, 4, 4 plus 4, 8. Total 8 exceptions are there. So when you're going to make a list of the net assets for the acquisition entry, your mind need to be clear on 8 exceptions. You may not be remembering that this is a recognition or a measurement or both exception, but you need to know that there are 8 exceptions in all. There is an exception number 1, contingent liability, recognition 1. Then there are a total of 3, you can say, measurement exceptions, NCA held for sale, reacquired rights, as well as the concept of share-based payments. And then there are 4 recognition measurement exceptions. One is called income tax, Index 12, employee benefits, Index 19, indemnification assets, and you can say leases. So now we need to understand these 8 exceptions in detail. We will go one by one on these exceptions. First, I'll start my discussions with recognition exceptions, contingent liability. Then I will come to the inputs in terms of other items as well. Few items I'll be discussing later. I'll give you that map plan. But I think it's time first to give you a break as well. I know your mind must be getting a little tired. So relax your mind, friends. I'll join you after 10-12 minutes after the break. Relax your minds. Okay. you had a relaxation of mind. So we started our discussion on the step number 3, which is making a list of the net assets. And I'm giving you basically 3 areas of exceptions. To quickly take a recap in what are the exceptions, you need to keep a basic principle in mind. Just keep in mind that this is the balance sheet of the acquiree and this is the acquisition entry. Now, what is appearing here is going to appear here as well. And this is going to appear at a fair value. So the basic principle is what appears in the balance sheet of the acquiree appears in the acquisition entry at a fair value. Now, there are 3 exceptions. What appears in the balance sheet also appears in the acquisition entry, but other than a fair value. One exception that is supposed to be a measurement principle. So measurement principle, there are 3 exceptions. So it is appearing out here and it will appear here, but not at a fair value. So 3 exceptions in this case: share-based payments, reacquired rights, and we've seen the assets held for sale. We'll come to those exceptions in detail. Second, we can say what is not appearing here will appear at a fair value or will appear other than a fair value. So if it appears at a fair value, 1 exception, contingent liability, and it's going to be other than a fair value, 4 exceptions, that is income tax, employee benefits, indemnification assets, and leases. Now, let's start with the very first exception, that is a contingent liability. So let me, take you back and do my discussions. We'll look at examples also, but I think I just need to, first create an image in your mind. So let me, start with my first set of exception. So I am coming to the exception list number 1. And the exception list number 1, we are saying is the recognition exceptions. These are called the recognition exceptions, and the recognition exception is only 1. So we're looking at the recognition exception, and that is if you look at the balance sheet of acquiree, it is not appearing in the balance sheet of acquiree, but if you look at the acquisition entry, it should appear in the acquisition entry, and that's going to appear at a fair value. This is the basic thumb rule which we need to keep in mind. So what is the item which enters the list? The exception in this is contingent liability. It is called contingent liability. Now, please hear me very carefully, because I want to give you the larger concept, because many people I've seen have got a misconception. And you know what they always believe? If there is a contingent liability in the balance sheet, if there is a contingent liability in the books of the acquiree, please show it as a part of the acquisition entry. No. Now let's first understand the larger concept. As far as the acquiree is concerned, he would have applied Ind AS 37. As far as the acquiree is concerned, he would have applied Ind AS 37 to decide whether it is a contingent liability or is it supposed to be a case of provision. And if you technically ask me, there are basically 3 parameters on the basis of which you decide, are we creating a provision or are we calling it as a contingent liability? I'd just like to remind you what the parameters you've done in Ind AS 37. The parameter number 1 was that we used to decide, is the obligation present or is it possible? So we used to basically decide that is the obligation present or is the obligation possible in nature? So we're looking at, is the obligation present or is the obligation possible in nature? Now, when you used to say that it is a possible obligation, it used to become a case of a contingent liability. So when we used to say that it is supposed to be a possible obligation, it used to become a case of a contingent liability in this particular case. The second condition which was there in Ind AS 37 was relating to the probability of cash outflow on a settlement. So we used to say that once there will be a settlement, there will be a cash outflow, and the probability of the cash outflow should be 50 or more than 50. So let's put it like this. We used to consider that the outflow probability is more than 50% plus, or is it 50 and below? If the probability of outflows was 50 or less than 50, then also it used to become a contingent liability. So which means that there might be a present obligation, but the probability of outflow in those cases is 50 or less than 50, it becomes a contingent liability. And the third parameter was regarding the concept of a reliable estimate. That can we make a reliable estimate or not? And if we used to say that no, we cannot make a reliable estimate, then also it used to be a contingent liability. Let me just put this once again to you. So we can say in this particular case that there are a total of, you can say, three kinds of contingent liability in the notes to accounts of the equity. You heard me correct. I'm saying that there are a total of three kinds of, you can say, contingent liability in the notes to accounts of the equity. Number one, possible obligations are contingent in the notes. Number two, obligations which are present but the outflow probability is 50 or less than 50. They're not probable. And number three, it is a present obligation, but the estimation cannot be done. So all these three kinds of contingent liability are appearing in the notes to accounts. Now, what does Ind AS 103 tells me? Ind AS 103 tells me that in the acquisition entry, when you put this entry in the books of acquirer, when you put this entry in the books of the acquirer, they say he is not going to look at Ind AS 37. He is not going to look at Ind AS 37, but he will look at the principles laid down in Ind AS 103. So they overrule the concept of Ind AS 37, which the equerry was applying, and they say that he is going to look at the concept of Ind AS 103. Ind AS 103 looks at a contingent liability with only two parameters. Ind AS 103 says that there are two parameters. The parameter number one is we need to see that there is supposed to be a present obligation. We need to see that there is a present obligation. It does not talk of possible obligation. It does not talk of a possible obligation. It says, number one, tell me that there is a present obligation. And number two, you can estimate a fair value for this present obligation. You can estimate a fair value. So there is a present obligation whose outflow is probable or not, doesn't make a difference to me, whose estimate can be done or not. But if you can tell me the fair value, please capture it as an actual liability in the entry. So if these two parameters are met, then it will appear as an actual liability in this acquisition entry at a fair value. So does this mean that I am supposed to filter the contingent liability in the notes to accounts of the equerry and decide which will appear in the acquisition entry or not? Yes. So the moral of the story, I would say, the equerry applied Ind AS 37. And he says that I've got three kinds of contingent liability. Number one, possible obligation. Number two, present obligation, the outflow is not probable. Number three, present obligations, the estimations cannot be done. He's got three kinds of contingent liability in the notes to accounts. A possible obligation, one. A present obligation with a probability of outflow below 50, 50 or below. And number three, a present obligation whose estimate cannot be done. Now, the acquirer is supposed to say, I'm not looking at what you're doing as per 37. My Ind AS 103 tells me that I will see, okay, is this contingent liability present? Number one, can you get a fair value of this liability? Yes, please capture it. So is this liability going to be captured in the acquisition entry? No. Is this contingent liability and is this contingent liability be captured in the acquisition entry? I would say depends. I would say depends. If you can get the fair value, capture them. If you cannot get the fair value, don't capture them. So the basic thumb rule is, if there is a possible obligation in the books of acquiry, doesn't appear in the acquisition entry. If there is a present obligation which is a contingent liability, for any reasons outflow is not probable or the estimation cannot be done, it will be captured in the entry if fair value can be determined. If fair value cannot be determined, it's not going to be captured. In fact, this summary is also very clearly given in the study material as well. I would like to take you back on the chart which is given in the study material on this exception. Let's, I think, have a look at this exception as well, which I want to show you. Wonderful chart indeed as far as a contingent liability is concerned. Let's have a look at the study material summary of this inputs. Let's see a summary of this particular input. This is in the study material. Let's read this out. Now you can see that as per Index 37, the acquiree would have applied Index 37 and the acquirer is going to apply Index 103, business combination. So when it is a possible obligation, it is contingent in the books of acquiree. It is not recognized in the books of acquirer. Possible obligations will not enter the list. Then there is a present obligation, but it is not probable that outflow will take place. It is not taken, but it will be taken into account if the fair value can be measured in this particular case. And if you say there is a present obligation, the outflow is probable, but it cannot be measured reliably. If it cannot be measured reliably, that means fair value cannot be determined. If the fair value cannot be determined, not recognized, and even not recognized out here. So it is the nature of the contingent liability which will decide whether it can appear in the acquisition entry or not. Typically speaking, you can put it like this. There is a possible obligation in the notes to accounts of the acquiree. Can it appear in the acquisition entry? No. There is a present obligation in the notes to account because the outflow is not probable. Can it appear in the acquisition entry if you can get the fair value? Yes. Number 3, there is a present obligation. Outflow is probable, but due to rare cases, it cannot be estimated. It is contingent in the acquiree. Will it be captured in the acquisition entry? Technically, no. If he could not get the estimation fair value, how would he get an estimation? But if he can get the estimation, of course, I'll show it. So typically, only present obligations whose fair value can be measured are going to be captured as actual liability in the entry. I hope, friends, I am pretty clear with the picture, right? Am I pretty clear with the concept of contingent liability? Which contingent liability in the notes to accounts of the acquiree will get captured in the acquisition entry in the books of acquirer? Wonderful indeed. Let's, I think, have a look at an example as well. There is a particular example number 15, which is given out here. It says a suit for damages of 10 million is filed on a company B for alleged breach of certain contract provision. The company B disclosed the same as a contingent liability in the financial statements as it considered it is a present obligation for which it is not probable that amount will be payable. So it is the second category of contingent liability where it is a present obligation, but the outflow is not probable in nature. Company A acquires B and determines the fair value of this contingent liability to 2 million. Since the acquirer can get the fair value of this contingent liability, it will appear as a part of the entry. So A would recognize that 2 million in the financial statements as a part of the acquisition accounting, even if it is not probable that payment will be required. Simply because the fair value can be determined, it's enough. Even if you still tell me that the probability of outflow is below 50, doesn't make a difference to me. It is a present obligation and the fair value can be estimated. It's going to be a part of the acquisition account. My exception list 1 is done. My exception list 1 is done. I now need to take you to the next block of exceptions. Let's go to the next block of exceptions. So this contingent liability is done. Now I need to give you a second block of exceptions. So I think let's work upon the exceptions which are there in terms of the measurement principle. We're looking at the measurement principle exceptions, and there are 3 exceptions: share-based payment as per 102, assets held for sale as per Ind AS 105, and the reacquired rights. This is measured on the basis of contractual terms. Now let me explain. Let me explain the share-based payments. Let me explain the assets held for sale, NC held for sale, and the concept of reacquired rights. Watch this. I'll just come back to this position. Let me just come back and explain the second list of exception. So this was my exception list number 1. Let's now come to the exception list number 2. So let's see what is the exceptions in terms of list number 2. In fact, let me also tell you, there is one wonderful question which is given in the revisionary test papers. I don't remember the year, but I'll probably, tell you later once we start doing full-fledged questions. That question contains the entire nitty-gritties in terms of step 3. Whatever complications arise on step 3, that particular question is devoted to the concept of the step 3. So I'm coming to the exception list number 2. We're coming to the exception of list number 2, which is supposed to be measurement exceptions. Which is supposed to be measurement exceptions. So let me explain this in a logical manner, that what are these measurement exceptions. As I said, there are a total of 3 exceptions. One is called share-based payments. Now, please watch this carefully. I will not be able to give you complete details at this stage, but I'll just give you some details at this particular stage. So let me give you the exceptions number 1. So let's see the exceptions and let's see some remarks out here. The first exception is called share-based payment, SBP, on which Ind AS 102, or let's not put out here 102. So there is a share-based payments. Now, when you look at a share-based payments, hear this carefully. Ind AS 102 accounts for the share-based payments at a fair value, but the fair value as per Ind AS 102 is not determined as per Ind AS 113. But when it comes to the share-based payments under Ind AS 103, you are going to consider the fair value as per 102 only. Which means Ind AS 103 is telling me, as a general principle, please take fair value. Which fair value? As per 113. Hear this carefully. When it comes to Ind AS 102, we consider things at a fair value, but this fair value is not 113. This is a fair value which is determined as per the Black-Scholes model. Ind AS 103 tells you that you need to capture the things at a fair value, which is as per 113. Now the problem is that share-based payment considers a fair value which is not in accordance with Ind AS 113, but it is based on a Black-Scholes model. So the standard very clearly tells me that in this particular case, I will consider the fair value. I will consider the fair value as per Ind AS 102. I will consider the fair value as per Ind AS 102, which is not computed as per Ind AS 113, which is not computed as per Ind AS 113. So you are recording it not at a fair value as per 113, but you're going to record it at a fair value as per Ind AS 102. Therefore, it becomes a measurement exceptions because you are recording it at a fair value, but not 113, 102. Black-Scholes model is what we're going to use. Now, let me also tell you one thing. This share-based payments, which I am giving you out here, I will learn the details of what value is incorporated in the entry when I discuss step number 4 PC. So I will discuss the share-based payments. We will discuss what value is taken. So we will discuss what value is taken as a part of acquisition entry. So we will see what part is taken as a part of the acquisition entry. I've just given you that we'll take a fair value as per 102. But what fair value? How much? That details we'll see later. So we will discuss what value is taken as a part of the acquisition entry when we discuss the step number 4, that is purchase consideration. So right now you know that there is an exception, but we will see the inputs of this particular exception later. We're going to see this exception later. So you just need to keep in mind that we will consider this as a part of the acquisition entry. We're going to keep this as a part of the acquisition entry, but what value we'll see in PC step 4. Let's go to the next exception. The next exception is what is called NCA held for sale, non-current assets which is held for sale. Now, if you remember in terms of Ind AS 105, the non-current assets held for sale is taken at a fair value less the cost to sell. It's not taken at a fair value. It is taken at a net fair value. So in the business combination entry, you can't afford to take it at a fair value. You need to take it at a net fair value only. Therefore, it becomes a measurement exception. So we will consider it'll be valued at fair value less cost to sell. That is called FVLCTS, fair value less cost to sell, as per Ind AS 105. Of course, the fair value as per 105 is as per Ind AS 113, no doubts. But it is not a gross value, it is a net value. Therefore, it becomes an exception because you're not recording it in the entry at a fair value, but you're recording it in the entry at a net fair value, which is a fair value less cost to sell. Then comes the third exception, and that is called a reacquired rights. That is called a reacquired rights. Now, what is a reacquired rights? What is the value at which appears in the books of acquisition entry? We'll discuss in detail when we come to the concept of step number 4 again. So we will see the details. We will see the details later. It will be a part of this entry, but we will discuss the details when we come to step 4. So there are a total of, you can say, there are a total in terms of, I would say, a total of 3 exceptions. Measurement principle has got 3 exceptions. You can say number 1, if there is a share-based payments, it is taken at a fair value, not 113, but 102. How much? See later in step 4. Non-current assets held for sale will appear at a net fair value in the entry. And reacquired rights, what are reacquired rights? What is the value they appear in the books of the acquisition entry? We'll see that in step 4. So these 2 issues are pending. We'll do a detailed discussions on share-based payments and in terms of reacquired rights when I come to the step number 4, because this will also impact the purchase consideration as well. That is my exception list number 2. Now I need to take you further on more exceptions. So let's have a look back now on the chart again and let's see more exceptions at this particular stage. We'll understand all these inputs as we go to the questions. When you read the questions, you'll get the feel, okay, is it recognition exception, measurement exception, both the exceptions, what is the value to be taken as a part of the acquisition entry? Now we're looking at both the exceptions. There are 4 exceptions. One is income tax, one is employee benefits, one is indemnification assets, and we're looking at leases. Now, let me give you one inputs point blank. When you look at the balance sheet of the acquiree, he's recorded the assets and liabilities at book value. Please hear this very carefully. So when you look at the acquisition, when you look at the acquiree's company balance sheet, he's recorded the assets and liabilities at a book value, and they are getting incorporated in the entry at a fair value. This means the carrying amount will differ from the tax base. When you're going to incorporate these assets and liabilities at a fair value, which means the carrying amount becomes the fair value. But the tax base will be equal to the original cost, because deductions which you will get under the income tax is going to be based on the original cost. So there will be a difference between the carrying amount and, you can say, the tax base of these assets and liability. The difference in the carrying amount and tax base of liability will result in a deferred tax. So the deferred tax, which is not in the acquiree's balance sheet, will appear in the acquisition entry, and of course it's not at a fair value. So therefore it becomes a recognition and a measurement exception as well, because you are going to capture the deferred tax asset and liability on all the assets and liability which are taken other than a fair value. So this results in a DTA DTL, which is going to be incorporated in the acquisition entry itself. Therefore this becomes exception 1. We'll write it down. Second, we've got employee benefits. So when we take an employee benefits, which means these employee benefits may not be captured in the books of the acquiree. But when it comes to the acquisition entry, I will capture the employee benefits not at a fair value, but based on the principles laid down in Ind AS 19. So employee benefits will be incorporated in the acquisition entry at using Ind AS 19. Then the third is the indemnification assets. I'll explain that also with an example, but let's get it very clear. There is a legal case against the acquirer, legal case against the acquiree. The acquirer says, if I'm going to take your company, I am going to bear the brunt of this legal case. The acquiree says, sir, don't worry. If the case is lost, I'll compensate you for this loss. I'll indemnify you for this loss. So which means that in the books of acquiree, there is no indemnification asset. There is only a court case, a contingent liability, which is incorporated as an actual liability in the acquisition entry. And the acquiree says, I will indemnify you against this particular loss. So that indemnification asset is going to get created in the books of the acquirer. And then comes the fourth exception, that is the case of leases, that I think we'll understand when we come to a question that would be better. So let me put my next list of exception. Then I'll consolidate the picture to you in terms of step 3. So this was the exception list number 2. Let's see the exception list number 3. So I'm now looking at the exceptions in terms of the list number 3. I know this is getting quite complicated indeed until we see a practical illustration on these exceptions. It's difficult to create an imaging in mind as well, but no worry. We'll soon be coming to that point as well. So we're looking at the exception number 3, which is both recognition and measurement exception. It is both recognition as well as a measurement exception. So this is a total of 4 lists in the exceptions. There are 4 items listed in the exception. So the exception list number 3, both recognitions and the measurement exceptions. So we've got a total of 4 exceptions in mind. So let's, I think, put a small little chart out here and we can just see the exceptions. Number 1, we are looking at deferred tax. I'll put it as income tax, but let's basically consider this to be a deferred tax. So you need to get this one thing very clear in mind, and I'm going to add some inputs at this stage. So we need to consider that this is the books of the acquiree. where all the assets and liabilities are taken at a book value. And when it comes to the acquisition entry, you are recording mainly at a fair value. So when you're going to record them at a fair value, so what will happen in this particular case? You can say for the purposes of Ind AS 12, the carrying amount will not equal to the tax base. Because these assets and liabilities are taken at a book value, but in the entry they're taken at a fair value, resulting in a difference between a carrying amount which is equal to the fair value and the tax base being different. So this will lead to, you can say, a deferred tax liability or a deferred tax asset. And this will be incorporated in the acquisition entry itself. Any DTA, DTL will be incorporated in this entry. So my advice, friends, is going to be superb to you. When you do the step number 3, it is better to divide the step number 3 in terms of step number 3A and B. I would insist that when you do a step number 3, you split your step number 3 in terms of 2 steps. You organize step number 3A. First apply Ind AS 12. And then you go to step number 3B and make a list of the net assets. So my advice in this particular case is that you are going to make a step number 3A. In step number 3A, you first apply Ind AS 12 aspects. Watch out in the question, is the tax rate given? If the tax rate is given, it will lead to deferred tax consequences. Organize the step number 3A. If the tax rate is not given, then the step number 3A will not apply. Your focus in terms of step number 3A is a tax rate given in the question? So when you're going to do the question in this particular case, my advice would be that put across a question to yourself, that is a tax rate given or not? So if the tax rate is given, then I would say you can apply Ind AS 12. Apply Ind AS 12, organize the step number 3A, get the deferred tax asset or liability on each and every asset and liability. But if the tax rate is not given in the question, then Ind AS 12 will not apply. Then in this particular case, Ind AS 12 is not going to apply. Then there is no need to organize the step number 3A. So your step number 3A will completely depend upon whether we are given a tax rate in the question. So as a part of the larger question, your first focus would be that let me see, is a tax rate given? If it is given, let's organize Ind AS 12. And you will get independent questions also, where the examiner gives you the details of the assets and liability, and he only tests your knowledge in terms of Ind AS 12, deferred tax position. So I would advise that as a part of this exception, please take care of this exception in a step number 3A altogether. See that the carrying amount of the assets liability differs from the tax base because of fair value. Organize the deferred tax. And then after you've done that, then you can take care of step number 3B. And make a list of all the net assets after looking at the exceptions. I'll make a mind map also on this very soon. So in this particular case, this is the point number 1. Now let's see the second exception in this case. The second exception is in terms of employee benefits. The second exception is in terms of employee benefits. And in terms of employee benefits, we will simply apply Ind AS 19. So whatever Ind AS 19 tells me about creating a provisions or a plan assets, I'll take care of the provisions what Ind AS 19 does. 103 is not overriding Ind AS 19. It overrides Ind AS 37 for a contingent liability, but in this case you will apply Ind AS 19. Next. The third inputs to be considered in this particular case, apart from the employee benefits, is indemnification assets, which I'll discuss with an example very shortly. So this is regarding the indemnification assets, where the acquiree agrees to compensate the acquirer for legal claims against him. He says that there are certain court cases against me, and if I lose the case, don't worry, I will compensate you. So we will see this in an example. So this is basically, we can say, a compensation. This is a compensation by equerry. This is a compensation by equerry for legal claims against it. For legal claims against it. So he says, don't worry, these are claims against me before the acquisition. I will compensate you. How we are going to capture the indemnification assets, we'll see. And the fourth exception in this case is leases, but this we will not discuss at this stage. This is going to be discussed later. So let me consolidate the learnings at this particular stage. First, let's go to the indemnification assets. And after this indemnification assets, we'll go further. So now my mind is working in terms of the step number 3, how I will organize things. I'll make the mind map, but let me first discuss the indemnification assets given in the study mat. So let's have a look at the indemnification assets with you. Contingent liability is done. I think we can look at the indemnification assets out here with an example. So we can have a look at the example in terms of indemnification assets. I'll cut it out. Let's have a look out here. So I'll give you some inputs on the indemnification assets with the example and with the illustration 15 as well. Watch this. Company A acquires Company B in a business combination on 1st April X1. B is being sued by one of the customers for breach of contract for 250. The sellers of B provide indemnification to A for the reimbursement of any losses greater than 100. So there is a legal case going on against the equerry. So in this case, equerry tells the acquirer, don't worry, sir. If this claim arises, I'll compensate you, I'll indemnify you for any losses which is greater than 100. If the loss exceeds 100, he says, I'll compensate you. So how much will he compensate? If the liability triggers at 250, 150. He says that I will compensate you if there is a loss more than 100. So if you get a loss more than 100, I compensate you. There are no collectibility issues around this indemnification. As on the acquisition date, Company A determined there is a present obligation and therefore the fair value of the contingent liability is 250. A will also recognize an indemnification asset of 150. Now please hear me carefully. I'm now going to give you some more details on the indemnification assets and then we can document that. Please hear this carefully. I am now looking at this example in a little more detail. So there is an acquirer and there is an equerry. I need to tell you 2-3 important inputs at this stage. So let's say there is an acquirer and let's say there is an equerry. There is a legal case going against the equerry which is represented as a contingent liability in the notes to accounts. Acquirer applies the concept of Ind AS 103 and reaches a conclusion that this is to be captured as an actual liability in the books of accounts. It's a present obligation, and since it can be measured at a fair value, it gets captured as an actual liability in the books of A in the acquisition entry. Second, in the same example, now B Limited, the equerry company tells him that I will reimburse. He says, I will reimburse the claims against this particular case. He says, sir, don't worry. You are going to take over this legal case which you're capturing as an actual liability. I'll reimburse you the claims. Now the question rises, if he gets a reimbursement claim, can he recognize an asset? So he will be able to recognize the indemnification asset in his books. So the claims which he will compensate him can be recognized as an indemnification assets as well. Now watch the three things carefully. Three things carefully. If this is recorded as actual liability, only then indemnification asset can be recorded. Mind it carefully. If this actual liability is recorded, indemnification can be recorded. If it is not recorded, indemnification cannot be recorded. So if the acquirer records the contingent liability, he can capture the indemnification asset. If he doesn't capture the liability, indemnification asset cannot be recorded. One. Second, this is one principle which we need to keep in mind. Second is he can record this indemnification only when there is no collectibility issue. When there is no collectibility issue, as you can see written out here, that it says there are no collectibility issues. There is no collectibility issues in this particular case. He needs to be certain that I'll get this money from the acquiring company. No collectibility issues. Number two. And number three, when he's going to record this indemnification asset, the indemnification asset cannot exceed the amount of liability. It has to be equal or less. The value of the indemnification asset cannot exceed the value of the liability. If the liability recorded is 20 lakh, indemnification is 20 or below 20, not greater than 20. So let me make the point very clear now. There is a contingent liability in the books of acquiry. It gets captured as an actual liability. That was the contingent liability exception. The acquiry says, I will reimburse or compensate you for this compensation. So there are three parameters to be evaluated. Number one, you need to evaluate if he recognizes a liability, only then he can recognize an asset, not otherwise. He can recognize the asset when there is no collectibility issues. And the value of the asset recorded cannot exceed the value of the liability. I hope you got my point. So for the indemnification assets, I'll come back to this. I just want to add the points out there itself. In the exception list which I gave you, let me just add the points out here itself. So when I'm looking at the indemnification assets, we can say in terms of the indemnification assets, there are 3 points to be taken care. There are 3 points to be taken care. Number one, recorded only if, it is recorded only if contingent liability is recorded as actual liability. If contingent liability is recorded as actual liability. If he records the contingent liability as an actual liability, only then I can record it. Number two, no collectibility issues. Prove it to me that there is no collection issue. So there is no collectibility issues in this particular case. And number three, the asset value has to be, you can say, equal to or less than the liability value. It cannot exceed. The value of the indemnification assets can be equal or less than the liability. It cannot exceed. These are the 3 parameters before this indemnification asset is recorded. Wow. I think let's have a look at one more example. Then I think it's time to do some consolidations as well. Step number 3 is very, very interesting. So let me just come back on the agenda. I want to now take you to another example, illustration 15, which is given in the study material. Let's have a look at illustration 15, where we will see these 3 parameters altogether. ABC acquired a beverage company, and at the time of acquisition, PQR is the defendant in a court case whereby certain customers have alleged that its products include pesticides in excess of the permissible levels that have caused them healthy damage. PQR is being sued for a damage of 2 crores. XYZ indemnified ABC for the losses, if any, due to the case up to 1 crore. So the acquiring company tells the acquirer that there is a legal case against me. If I lose, I compensate you 1 crore. And the fair value of this contingent liability is 70 lakhs. Since this contingent liability has got a fair value, you are going to recognize it as a part of the acquisition entry. So in the acquisition entry, you'll end up recording the contingent liability at 70 lakhs. Can I record the indemnification assets? You can, if there is no collectibility issue, but you cannot record more than the amount of contingent liability as well. So in this particular case, though I'm going to get 1 crore rupees, but I will have to restrict it to 70 lakh rupees only because the value of the indemnification assets cannot exceed this amount. I hope you got the point. So this is recorded, therefore this is recorded, but this is recorded 70, so this will be restricted to 70. How should ABC account for the contingent liability and the indemnification asset? What if the fair value of the liability is 1.2 crores? Then the indemnification assets can be recorded at 1 crore. So in the first case, we can say that the corresponding indemnification assets will be 70 lakhs. In the next case, since the liability is 1.2, the indemnification will be 1 crore. So moral of the story: liability recorded, asset recorded. Liability recorded, asset cannot exceed the liability, and collectibility issue should not be there, then there is no problem. I hope, friends, you got the picture in terms of the indemnification clause. I think now it's time to give you a mind map in terms of the step number 3 as well, what we have learned in terms of step 3. So let me just make a mind map at this stage. So I'm just going to come back on the agenda. The 3 exceptions are done. It's important now to consolidate the thought processes in terms of the step. That's wonderful indeed. Okay, let's, I think, take this further. Now my mind is working very clear. How will I tackle my step 3? So please look at this mind map very carefully. One of few things, of course, we yet to discuss in detail in step 4. So I am creating my mind map in terms of the step number 3. How are you going to progress in terms of the step number 3? That's a very crucial inputs to be decided how I will proceed in terms of step 3. My advice, as I said earlier, is you are going to go in 2 stages in step 3, step 3A and step 3B. So what I'll do in this particular case, I will organize the details in 2 steps. We will first organize the step number 3A, and then we'll organize the step number 3B. So every time you look at step number 3 in a question, go faithfully. So in terms of step 3A, you need to first of all see, is the status of the tax rate given in the question or not? So there are 2 possibilities which can arise. We can say that the tax rate is given or the tax rate is not given. Well, if the tax rate is not given, then I think my step number 3A is not applicable. I'm saved with the trouble of creating any DDA, DDL. So in this particular case, we can say Ind AS 12, that is not applicable. But if you say it is given, then Ind AS 12 applicable. Ind AS 12 applies in this case. So what are you going to do in this particular case? You will organize all the assets and liabilities and see where the carrying amount and tax base differs. Read the question carefully, organize the list of all the assets and liability whose carrying amount, which is now equal to fair value, differs as compared to the tax base. So what we'll do in this case, we will identify, read the question, identify all assets and liabilities. Identify all assets and liability whose carrying amount. Now the carrying amount for your reference is equal to the fair value. because you're recording things at a fair value. So this is all at a fair value. So you need to compare whose carrying amount is different. It is supposed to be different from tax base. So you need to identify all those assets and liabilities whose carrying amount is different from tax base, and this will lead to a deferred tax asset or a deferred tax liability, as the case may be. And remember, this DTA DTL will be incorporated in the acquisition entry itself. So let me also make a mention that this will be a part of the acquisition entry. When I say it's a part of the acquisition entry, you are going to include it. You will include it in the list of net assets. So you will include this in the list of the net assets. So organize it and then take it as a part of the list of net assets. So your focus in step number 3A will be purely on Ind AS 12. Because I just need to see that the DTA DTL is arising, which I will incorporate as a part of the entry. Now, moving further. Now it's time, in terms of the step number 3B, that I make a list of net assets. Now, when you make a list of the net assets in this particular case, your mind needs to be working like this. What is in the balance sheet of the acquiree? What is in the balance sheet of the acquiree? You are going to take it as a part of the list. You're going to take it as a part of the list at a fair value. So whatever is there in the balance sheet of the acquiree, it's a part of the list at a fair value for sure. But then there are 3 exceptions coming in. And we need to be careful on those 3 exceptions. So you need to be careful on the 3 list of exceptions. So as I said, the first is on the measurement, or rather let's take the recognition. So the first is on the recognition exceptions. So the moment you're doing this particular exercise, just recall that there are certain exceptions at the back of the mind. One is the recognition exceptions. Now, in the recognition exceptions, you've got contingent liability, but not all. Present obligations whose fair value can be measured will get captured. So we will take all those contingent liability, which is a present obligation, plus we can estimate the fair value. So look at all those contingent liability which are present obligations, and the fair value can be estimated. Next, we're going to look at the measurement exceptions. Now we're going to look at the measurement exceptions, and there are 3 measurement exceptions. The first one is a share-based payment, SBP. The second one is an NCA, which is held for sale. And the third one is supposed to be what we said, reacquired rights. The third one is called reacquired rights. Now, as far as share-based payments and as far as reacquired rights are concerned, I've only given you that they will be recorded based on Ind AS 102, and this is going to be recorded, but what values? Not discussed the details so far. So these details we'll be discussing very soon. So as far as the share-based payment is concerned, as far as the reacquired rights are concerned, we will see the details. We will see the details in step number 4. So when I come to the purchase consideration, I will discuss more details. I have left the share-based payment discussions and the reacquired right discussion so far. We'll do that in step number 4. But just remember, they are a part of the list. Now, when it comes to NCA held for sale, it is going to be taken at a fair value less the cost to sell. Therefore, it becomes a measurement exception because it is taken at a net fair value. And then comes both the exceptions. That means it is recognition and a measurement exceptions both. And now, if you know, there were 4 items in the list, but I've condensed it to 3. because the income tax is something which I've segregated in terms of 3A. So effectively, my list from 4 exception condenses to 3 exception. The first exception, income tax, is already taken there. So we need to consider indemnification assets. We need to consider the indemnification assets. And when you're considering the indemnification assets, you got a 3 criteria approach. You got a 3 criteria approach in this case. Liability is there, asset is there, asset cannot exceed liability, and collectability issues are not there. So I'm just going to make a mention that there is a 3 criteria. There is a 3 criteria to be met. You've already seen what is the 3 criteria earlier. So the 3 criteria is going to be first evaluated and then recorded. Then the next one is supposed to be employee benefits, and the third one is supposed to be leases. So I'm not giving you much details in terms of employee benefits. In terms of leases, we said leases we'll discuss later. Employee benefits as per Index 19, whatever Index 19 tells me. So in terms of employee benefits, I'm going to apply Index 19. So as far as leases are concerned, so leases will be seen later in a practical question. When we come to any practical question, we'll have a look at that. So now you can see the entire inputs at this stage conceptually. Your step number 3A is deferred tax. Your step number 3B, take this deferred tax also as a part of the list out here. And when you take it as a part of the list out here, then in this particular case, get the contingent liability clear, get the share-based payments and NCA and reacquired rights clear, indemnification, employee benefits, and leases. Now, let me also give you a good comfort feeling. Out of all these agendas, what is the maximum you're going to see in the question? Contingent liability for sure. Share-based payments generally for sure. Reacquired rights could be a good frequency. NCA generally not. Indemnification assets, be careful. Employee benefit leases, majorly no. So you will see a total of 4 exceptions in the question. So at least the least which you need to think is contingent liability, indemnification assets, share-based payments, reacquired rights. These are the 4 out of, you can say effectively, 7 exceptions coming in. 8th one is already taken there. I hope, friends, I am conceptually clear on the 3-step model to you. Are we so far clear on the 3-step model so far? So far, so good on the concept in terms of exceptions to the 3-step model, right? Yes, wonderful indeed. Let's now do one thing. We are now going to go to a little more inputs in the study mat out here. So I'm just going to take you back on the study material to have a little more look in terms of these permutation combination. So this is all done. Indemnifications is all done. And now we are looking at a bit. I just want to tell you another last input as well, because this is something which will also come in the question. So we just want to have a little look further on the last area before we close for the day. Next class, we're going to devote time in terms of step number 4, purchase consideration, one of the most crucial steps in terms of the 7-step model. Goodwill and NCI is not a big deal, but the purchase consideration is going to be very deep. We might land up spending a good time in terms of only the purchase consideration. Now, there is something which I want to give you further in terms of the intangible assets. Now, watch this here. Apart from all these exceptions, you're also going to see another inputs as well. And that is, if you look at the balance sheet of the acquiree and you look at the entry in the books of acquirer, this is the balance sheet of the acquiree and this is the journal entry, the acquisition entry we're looking in the books of acquirer. There are certain intangible assets. There are certain intangible assets which do not appear in the balance sheet of the equity because of Index 38, internally generated. A company is prohibited in terms of reflecting those internally generated intangible assets. So there are a couple of internally generated intangible assets which are not being captured in the acquiree's balance sheet. But when the acquirer assumes the business of the acquiree, then these internally generated is going to become a purchased intangible assets for him. And if they are purchased intangible assets, they will appear as a part of the acquisition entry. So you got to see more inputs also and understand that there are certain internally generated intangible assets which is not appearing in the balance sheet of the acquiree, but they're going to be a part of the acquisition entry. Because what is internally generated for the acquiree becomes purchased for the acquirer. So I think let me just read the inputs out here. The acquirer shall record separately from goodwill the identifiable intangible assets acquired in a business combination. An intangible asset is identifiable if it meets the separability criteria which you've seen in Index 38 or the contractual legal criteria which you've seen in terms of Index 38. So all those assets which are internally generated will be featuring as a part of the acquisition entry in the books of the acquirer. That's all, friends, in terms of the exceptions and in terms of the guidance on the intangible assets. My step number 1, step number 2, and 3 is done. I've given you the inputs in terms of who is the accounting acquirer, what is the date of acquisition, and what are the recognition measurements, and both the exceptions in terms of step 3. So far, so good. I think that seems to be good for the day, and I think that's all what we have the time as for day. I am going to continue this on the next class where I'm going to spend a good time giving you a lot of insights on step 4, purchase consideration. But please remember, do your cumulative revisions on this standard. It's a complicated standard, so you need to keep on doing your cumulative revisions in this case. Over to you two for any questions on your side, friends. Right, I think thank you 25 comes with a big lot of concepts. That's right indeed. Right, so thank you so much on that. I'll see you in the next class. Thank you, bye-bye, and take care. Thank you, Peter. Thank you so much indeed. Thank you, bye-bye, and take care. Thank you. Bye-bye.